Hello, everyone. I hope that you are having a good day so far, and welcome to another video. This time, we're going to talk about segregated funds and annuities. As I always have mentioned, my videos are not 100% covering all the material, but it will be covering the majority part of it. It will be enough for you to pass your exams as well. Most importantly, for you to understand what it means and how you can use it in your business. All right. So this is something that's really important. Keep in mind. Do not expect me to, talk about everything, 300 pages in the book in only 1 hour, but I'm going to cover at least 70 to 80% of it. And also, I'm going to make you guys understand every single part of it. Okay. So when we want to talk about segregated funds and annuities, something that's really important in the beginning is that we understand what types of income we have and also how are the tax rates calculated. So there are three ways that you can make money in Canada. If we're not talking about illegal stuff, legally, there are three ways that we can make money. One is employment or self-employment. The other one is having a business, a corporation. And the third one is investments. These are the three ways that you can make money. All right. Now, why are employment and self-employment the same? Because in employment, you are working for someone, and in self-employment, you're working for yourself. So the taxation system is the same, right? And in business corporations, corporations are a separate entity. So that's why that the taxation is different. And then investments has its own. And when we're talking about investments, there are three types of investments, all right? So three types of investment returns that we can have. The first one are interest investments. Second one are capital gains or assets. And the third one are dividends. Let's talk a little bit more about each of them. So what are interest investments? Interest investments are the ones just like guaranteed investments, bonds or treasury bills, saving accounts. So basically, you're just lending your money and you're getting a return on basically on that money that you've lent to. But when we're talking about capital gains, you're purchasing something, you're purchasing an asset. So it's like buying a stock, mutual funds, seg funds, real estate, all of these are assets. So it's not going to give you a specific rate of return, but there's a growth of value of whatever you've bought. And that is different from the interest type of return. And when we're talking about dividends, dividends are basically what are they? If you are a shareholder of a company and that company makes extra profit by end of the year, the company can make a decision to distribute that excess amount of money between the shareholders. So not only the stock itself is going to grow, right? And you're going to have capital gains, but you're also going to have dividends as well. All right. Which has a completely different taxation system. We're not going to go that much into it because it's not the topic of our, licensing material, but I will give a small information about it as well. So now that we talked about the different types of income and also different types of investment returns, let's talk about the basics of investment. When we're talking about investment, there are mainly three parts that we have to pay attention to. First part is what amount of money I'm investing, or what amount of money I'm depositing, or what amount of money am I purchasing, that stock or real estate or mutual fund. That is what we call an ACB, adjusted cost basis. So adjusted cost basis is the money that I put in for that investment. And then there's going to be either growth or interest, right? Growth in capital gains and interest in the interest type of investments or dividends. Eventually, it's going to give me a future value, which is the combination of my ACB plus growth. All right. So this interest, if it's calculated based on a simple interest, what happens is that you only get interest on the initial amount that you deposited. So you're only going to get interest every year on the ACB itself. And this is the formula. So your future value is going to be your present value plus your present value multiply interest rate multiply the amount of years. Okay. So when you want to do a calculation on a simple interest, how do you do that? Let's actually open up a calculator here. So this is a calculator. Let's say I have $100,000 investing, and that $100,000 is going to have a 5% simple interest rate. Okay. So what I'm going to do is I'm going to have this on a scientific one. So it's going to be $100,000, right? Plus, again, $100,000. Oh, my bad. $100,000 multiply. What is the interest rate? We said it like, for example, it's 5%. And let's say we're going to look at it for the next 10 years. All right. Actually, let's do 10 years. So the total is going to be $150,000. So if I invest in a simple interest investment, putting $100,000 with 5% interest rate, I'm going to have $150,000. All right. So what it means is that I'm only going to get, I'm just going to you know, reconfirm this. I'm only going to get interest on the initial amount. So if it's $100,000 and we're talking about 5% of $100,000 is $5,000. So every year I'm only going to get $5,000. So year number two, I have $105,000. Year number three, I have $110,000. And that's how it goes on, right? But then we have another type of interest as well, which is called compound interest. And in compound interest, you're going to get interest on top of interest. So let's say if this it's the same $100,000 at 5%. So first year, again, it's going to be 5% added to the $100,000. So it's going to be $105,000, right? But next year, you're going to get 5% of the $105,000. So it's going to be a little bit more than becoming $110,000. You're basically going to get another $250 from that $5,000 extra. So you're going to have 110, 250. Compared if it was a simple interest, it would have only been $110,000. So you get $250 more. And when we want to do the calculation, I'm going to show you guys a really simple way to make it happen, and it's going to help you guys a lot. So let's say if you want to do, again, the same example, $100,000, 5% interest rate, and we want to see what's going to happen after 10 years, right? So I'm going to do $100,000 multiply 1 plus the interest rate. So 5% means 0.05. So I'm going to put 1 plus 0.05. Now, what I'm going to do here is I'm going to click on the equal sign with the amount of years that I want to look into it. So right now, I want to see how it's going to look for the next 10 years. I'm going to click on the equal sign for 10 times. So 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. So as you can see, if I put it in a compound interest, that 5% interest rate is going to make my money turn out to be 160, almost $163,000. But when it was simple interest rate, it was $150,000. So there's about a $12,000, $13,000 difference based on what type of interest you're receiving. And why is this important? Because usually, right, and most of the times, those investments that are based on interest and you're lending money, they are simple interest, right? So a GIC, saving account, bonds, stuff like that. But stocks, mutual funds, SEC funds, ETFs, stuff like that, right? Real estate, they are calculated as compound interest. So they will give you more return. All right. So that is that. Now, what we're going to talk about here is about the taxation. So now that we understood the basics of investment, different types of investment, we've also talked about, what types of income we have. Let's look into what is the taxation system. So based on your employment or self-employment income, you are going to be identified with an MTR, okay? And an MTR, your marginal tax rate, is the highest tax rate that you're going to pay. What does that mean? Let's say if somebody's making $90,000, they're not going to be just, suddenly taxed by 40%, for instance. This is in a bracket situation. So maybe like from zero to $10,000 of their income, they're going to pay 10% tax. And then from 11, whatever they make, till let's say 40,000, they pay 20% tax. And then whatever they make from 41,000 to 80,000, they pay 30% tax. Now, this is just for the sake of an example. And then whatever they make from 80 to, let's say, 100, it's going to be 40% tax. So what that means is that if you're making $90,000 as your gross income, right? So before tax, it's not all going to be taxed by 40%. The first $10,000 is going to be taxed 10%. And then whatever you make more than $10,000 up to $40,000, it's going to be taxed by 20%. Whatever you make more than 40,000 all the way up to 80,000, it's going to be 30% tax. So because in this case we said the income is 90,000, there's a $10,000 income that falls into this bracket of 80 to 100, which is going to be taxed based on 40%. All right. So out of that $90,000, it's only the $10,000 on the top that's going to be taxed based on 40%. All right. And that 40%, which is the highest tax bracket that you are basically paying, right, and you're falling into, it is called your MTR or your marginal tax rate. That is the highest tax rate that you have. All right. Now, if by any chance, you see something called an ATR, right? An ATR is your average tax rate. It's basically looking into how much tax we're deducting from your income and just, basically looking at the difference. So let's say if your gross income is 90,000 and your net income is 50,000, okay? So basically you've paid $40,000 tax, right? So what they're going to do is they're going to do 40,000 divided by 90,000. Whatever this amount is, that is your ATR. That is your average tax rate, right? Which in this case, it's going to be about, I don't know, 45% or something like that. All right. So this is how your income as an employee or self-employed is going to be taxed. For businesses, as I mentioned, they're a different entity, right? The first $500,000, it's usually between 9 to 12%. I know this year that we're in 2025, it's 12.5% in Ontario. So it differs in different provinces, obviously. But whatever you make more than $500,000, it's going to be 27%. Okay. So the first $500,000 of your income as a corporation, it's going to be 9 to 12%, which is usually 12%. And whatever you, so if there's only $1 made more than $500,000, you have to pay 27% tax on that $1. All right. So that's the most important part. But when we're talking about the investment part, so for interests, it's whatever the growth is, whatever you've made, multiply your MTR or your ATR. And for capital gains, we have a 50% tax exempt. So that's the difference of taxation between interest investments and capital gain investments. Capital gain investments have a 50% tax exempt. So you only pay tax on 50% of your growth. Let's do an example. Let's say if you've put in $20,000, this is your ACB, it's the money that you've deposited. And now your market value or your present value is $50,000. Okay. So how much growth did you have? You've had a gain of $30,000. This $30,000, if it's a capital gain investment, you have a 50% tax exempt. So you pay tax on only $15,000. Let's say if your tax rate is 40%, so you have to pay 40% tax on this amount, which is going to be $6,000. All right. But if it was an interest type of investment, like a bond, a GIC, you had to pay tax on the entire $30,000. So you had to pay $12,000 of tax. That is the difference between capital gains and interest in terms of taxation, right? So one more time, just to review everything. There are three types of income: employment, self-employment, business as a corporation, and investments, right? Employment, self-employment, you identify your MTR based on that. In the exam, remember, if a person has six figures income, which is $100,000 and above, you will use their ATR if they've given you an ATR in the question. If not, and it's only MTR, you use the MTR for tax purposes and calculating them. But if they have given you both the MTR and the ATR, and their income is six figures, it's $100,000 or above, you use the ATR for your calculations. This is a very important note. We talked about corporations just as an additional information. So we talked about interest, capital gains, dividends, and also the basics of investment. So if it's a simple interest, this is how you calculate it. If it's a compound interest, this is what we do. And we talked about it that, hey, the calculation on it, you can just click on the equal sign for the amount of years, and that's going to save you a lot of time. Now, we want to talk about the different types of investments. Okay, we have different types of investments in terms of the nature of that investment. So we talked about it the other way as investments, capital gains, like interest, capital gains, and dividends. Now we're going to talk about in the nature of them. So there's stocks, shares, or equity are other names for it. Is when you become a partial shareholder of that company, you become an owner of that company. So every one stock that you buy, you own one stock or one piece of that company. But bonds means that I'm going to lend money to that company. So I am not going to be an owner of that company. I just lended money to them. Treasury bills, or the most common one was, which is a GIC, guaranteed investment certificate, is a type of bond that you lend money to the government. It could be the provincial government, it could be the federal government, it could be any different, different government body. And if you lend money to the government, it's going to be called treasury bills or GIC. So what's the main difference between stocks and bonds? In stocks, you are going to be affected by the ups and downs of the shares of that company. But in bonds, you are going to settle with a specific percentage, let's say 4%. So you give your money, you lend your money with 4%. If that company share goes up by 20%, you only get 4%. If it goes down by 20%, you will still get your 4%. So you are not affected by the fluctuations or the profit or loss of that company because you don't own that share. You've just lended money, right? And that's the difference between bonds and stocks. In stocks, it's the same thing. Because you are an owner, you will be affected by the growth or the loss of that share, right? And it's going to be the same thing for treasury bills and GICs as well. They are going to give you a specific rate. We have mutual funds. So what are mutual funds? And specifically, if we want to talk about it, segregated funds as well. They're both the same thing. The only difference is that mutual funds are purchased by banks, from banks, and segregated funds, or it's called IVIC. So you might take the segregated funds exam and you never see the word segregated funds, and they're going to say IVIC. You have to know that IVIC means segregated funds. They are both kind of the same thing, but we're going to talk more about it, what it is. Annuities is something else that we're going to talk about. I'm not going to go into it right now. Saving accounts, ETFs, exchange traded funds. I'm going to talk about it as well. Real estate, Canadian premium and saving bonds, and group plans. So again, one more time, when I buy a stock and I invest in stocks, I'm buying a part of that company. But when I'm getting a bond, I am lending money to that company. And if I lend the money to a government, it is called treasury bills, right? Now, a mutual fund or a segregated fund is a basket of a lot of different what companies inside it, which we call them holdings. And it could be a lot of stocks or bonds or treasury bills. Okay, so there might be government bonds in it, there might be stocks in it, there might be bonds in it as well. Okay, this is what a mutual fund is. So you'll be investing in all of them, and then there's a fund manager that will be moving the money inside that basket based on how those holdings are performing. So if Microsoft is performing better than Tesla, they're going to move more money into Microsoft, right? That's how it works. So we said that the difference between mutual fund and segregated fund is only from where you purchase it. If you purchase it from the banks or investment corporations, it's called mutual fund. If you purchase it from an insurance company, it is called segregated fund. Why do they call it segregated fund? Because insurance companies are mandated to separate the money that they get from the investments for their funds from any insurance premiums that they get because of their insurance sales. So they can't mix the two monies together, right? Any money that they basically receive from the clients for investments and segregated funds, it has to be separate from any other money that they get for premiums and other stuff. So ETFs, right? I'm going to talk about annuities later, but ETFs are exactly like mutual funds, but the difference is that they are passively managed. So a mutual fund or a segregated fund is actively managed. That means there's a team that's been managing that is managing it every day. But when we're talking about ETFs, it's only managed maybe every 3 months. So the percentage and the shares of each holding in that basket remains the same. And that is why that you can use it as day trading. But you can't do that with mutual fund and segregated funds. If you want to sell your fund and buy another one, it's going to take a couple of days. But an ETF gives you that ability of trading it, right? So that is why we call it ETF exchange traded funds. And obviously, if you want to have more information, MERs are lower, basically management expense rate, the fee that the portfolio managers get are lower in ETFs. Why? Because there's not an active management on it. But it's higher in mutual funds and segregated funds. Why? Because there's active management. Now, it's up to you to make that decision. Usually, mutual funds and segregated funds can give us more return and compared to ETFs. Usually, I said, not always, right? So you pay more MER, but you get more money at the end. Again, this is something that you have to look into your strategies. You have to have knowledge about it, and you have to speak with an advisor as well. So let's go and talk about segregated funds. It's a really important topic. It's basically the majority of what we want to talk about in this module. And let's go with it. So what is the main difference if I purchase this fund from an insurance company, all right, rather from a bank? What do insurance companies do? They give you a guarantee. So what is a guarantee? That guarantee could be either a maturity guarantee or a death guarantee. So what it means is that, let's say if you sign a 15-year contract, or let's say 10 years. Let's say if I sign a 10-year contract and I put $100,000 in it, and after 10 years, I have lost money. Okay, let's say if I have $90,000 or I have $70,000. There is a maturity guarantee that it will tell me that if at the end of that date of my contract, so when my contract matures, I will have some guarantee on my deposit amount. And the death guarantee means that it doesn't matter when, but whenever you do die in this contract and your market value is lower than what you deposited, you will have a guarantee as well. This is how they show the guarantee, and it's always either 75% or 100%. The left number is the one for maturity guarantee, and the right number is for the death guarantee. So let's say in this example that we put in $100,000, all right? If I have it with a 75-100, what does that mean? If by end of my contract, $70,000 is what I have as a market value, my guarantee was 75%. So I had $75,000 guarantee. But the market value is $5,000. So the insurance company is going to add another $5,000 to that $70,000 and give me $75,000. If my guarantee, my maturity guarantee was 100%, then the insurance company had to put in how much? Had to put in $25,000. Or sorry, $30,000 because the market value was 30. Okay? So depending on the percentage of your guarantee. It's the same thing for death as well. Let's say after 2 years, so it's not even the maturity time, the client passes away. At that time that the client passes away, it's $80,000, right? And they had a 75-100 maturity. So that death guarantee was 100%. So in this case, the company has to add $20,000 and give that $20,000. So it would be $100,000 total to the beneficiary. If it was 75-75, then the guarantee was only $75,000. The market value is already $80,000. So in this case, the company is not going to be adding anything because the market value is already more than the guarantee. The market value is $80,000. The guarantee is 75. So it's not like the company is only going to pay $75,000. They are going to give the market value. So whichever is higher, either the guarantee or the market value. Okay, this is really important. Why is it really important? Because maybe sometimes, and we're going to look into cases just like this, but maybe the market value is going to be, let's say, $76,000, right? So in this case, the 75% is still less than the market value. So there's going to be no top up. That's what they call it. There's going to be no top up from the insurance company to cover the losses. It's already more than the guarantee. Obviously, if we guarantee our clients with 75-75, so only 75% guarantee on the maturity date or the death guarantee, it's going to be cheaper because there's less guarantee on it. 100-100 is going to be more expensive. What we usually go with is a 75-100 for our clients, 75% maturity guarantee. Usually segregated funds are 10 plus years contracts. So it's really, really tough that you're going to be losing money after 10 or 15 years. So 75% guarantee is enough, but death could happen at any time, right? Just remember, this does not give you a guarantee if you want to withdraw money. Okay. So if you withdraw money on your own will and it's not by end of the contract or you didn't die, then there's no guarantee in it. It's whatever you withdraw. Okay. So as I mentioned, um, segregated funds are usually a 10-year or a 15-year, let's say, contract. Let's say if somebody has $100,000 deposited for 10 years, okay? And then after that, it turns out to be $200,000. They have the opportunity of renewing their um, contract and go for another 10 years, right? So this is what we call renewal, that the contract has matured, it's done, it's over, right? And then they renew it for another 10 years. This is a really important part. Let's say if that contract was based on 75-75. So over here, when they started, they had a $75,000 of guarantee. Now they have $200,000 and they're renewing the contract. So now the 75-75 is based on the $200,000. So they have $150,000 of guarantee. So if they die here and they die while the market value is $100,000, the company has to pay $50,000. They have to top up by $50,000. Why? Because at the time of renewal, the guarantee was based on the new market value. All right. I want to talk about this in another way as well. Let's say by the end of the maturity guarantee, after the first 10 years, the market value is $60,000. What's going to happen now? Because at the end of the maturity, it was $60,000 and the guarantee was 75, the company has to pay $15,000 top up. So now this $60,000 is actually going to turn out to be $75,000. And the next 10-year renewal on the contract, it's going to be 75% of the $75,000, right? So what is going to be 75? It's going to be about $56,000, something like that. Okay. So now the guarantee is $56,000. I hope you guys understood this. So this is what renewal means, that after the contract is done and matured, we'll look into it. If the market value is more than the guarantee, that is what it's going to be renewed with, and the new guarantees are going to be based on it. If the market value at the end of the contract is less than the guarantee, then the insurance company is going to top it up, and then it's going to go get renewed. And the new renewal, the guarantees are going to be based on the new deposit that they've done at the end of the first term. So that is renewal. Now, what is reset? Reset means that you are going to start the contract all over again in the middle of the contract. So what does that mean? I go with $100,000. It's a 10-year contract, right? But on year third, I see the market is $120,000, the market value. I decide to reset it. So even though that it was the third year, I'm going to reset and it's going to be year zero. All right. Why do I do this? Because I could change the guarantee to $120,000. Let's say if I was doing a 100-100 guarantee. At the beginning, obviously 100% of $100,000 was my guarantee. Now it's going to be 100% of $120,000. So if the client dies over here and the market value somehow is again $100,000, right? Because they reset their contract on third year, and now the guarantee is based on $120,000. Here, the insurance company has to pay another $20,000 to top it up, and they will give $120,000 to the beneficiary. But if they wouldn't have done that reset, basically they had $100,000 and they will get $100,000. That's it. All right. So we have two types of resets. The first one, it's automatic, which means that you will just reset it every year automatically, or maybe every 2 years, whatever it is designed for. Voluntary means that you're going to do it like, whenever you feel like it's the right time, but there are limitations to it. Like you can't do it every month or every week. They usually allow you to do it once a year. Okay. So let's look at a couple of examples just to make sure that we understood everything. Let's say somebody puts in $100,000 on year zero. Let's go with a 75-100. So 75% guarantee on the maturity date and 100% guarantee at the time of death. So let's say in this case, at year seven, the client passes away. Because there's a 100% guarantee, right? And the market value at year seven is 80. If that client dies, the insurance company has to pay another $20,000, right? To provide that guarantee that they had for 100%. Let's say if it just matures on the 10th year, right? And the market value is actually $45,000. What's going to happen here? Because the guarantee was 75% of the maturity date, so of the deposit on the maturity date, so they were guaranteed for $75,000. So the insurance company has to add another $30,000 to this $45,000 to pay the total amount. Let's say the client resets the policy at year five. So now at year five, they had $125,000. So now the 75-100 is based on the $125,000, not the $100,000. All right. So in this case, what's going to happen? If they die in this year, they're going to get $125,000 because it was a reset over here. So the guarantees are now based on the $125,000. Okay. This is really important. So you guys can actually use this chart, right? And just do a couple of different examples for yourselves. But I think that I covered all the different types that it could happen. Reset, renewal, all of that. Let's say again, if it was 75, 75, a 10-year contract, you put in $100,000, a year 10, it's 45,000, right? So the insurance company is going to add another $30,000 because the guarantee is 75%. If they renew their contract, the new guarantee is going to be based on 75% of $75,000, right? Because now the new amount of money that they have is $75,000. So that's what's important. You guys can play around with it, give yourselves a couple of more examples, and you can always, ask your questions in the comment section. Now we're going to switch gears a little bit, and we're going to talk about, um, what are the different types of pensions that we have, okay? Now, obviously, there's going to be a lot of different accounts and pension plans that the book has explained about it, and honestly, it's really easy to look into them. All of them in the beginning, when you look into it, it says about the interest rates. It says about it talks about the advantages and disadvantages, the risks that it has, where you can purchase them, all of those stuff. So if you just search them in the index part, you're going to find everything, and it's not really going to be an issue. So I'm not going to talk about DPSP, DSPP, or whatever they are. But I'm going to talk about some important ones that have some, important notes as well, just so you guys can have it, and it's going to help you with your business as well. So the first pension plans that we want to talk about is obviously CPP, Canada Pension Plan, right? So Canada Pension Plan, in order to qualify for getting this as a retirement pension, is that you've had work experience, okay? And you cannot add more. So every time from your income, from your pay stub, you are paying a portion to your CPP, okay? And then you're not allowed to say, okay, I want to put in more from my income, from my pay stub to my CPP and allocate and invest it. You can't contribute more, okay? So it's whatever your income is, it's a percentage of that income. Your benefits start from age 65, right? But you can have the opportunity to start from age 60. If you start from age 60, there's going to be a 7.2% penalty for each year. So what does that mean? Let's say if at age 65, you were supposed to get $100,000 a month CPP. If you decide to get it at age 64, there's going to be a 7.2% penalty on it. So basically, you're going to lose $72, right? So it's going to be $928 a month that you're going to get. Okay. If you decide to start from age 63, then it's going to be 14.4% less. So it's going to be about 800 and what is it going to be? 56, I believe, something like that a month. Okay. So if somebody chooses to start 2 years earlier, it's going to be 14.4%. Again, if somebody starts to, even starts to get it 6 months earlier, So 7.2%, if you divide it by 12, it's 0.6%, right? So let's say if somebody starts 6 months earlier, that's basically 3.6% less that they're going to get. So you might have this calculation to be done, and it's pretty easy and simple. Just remember that for every 1 month, it's 0.6% deduction from the actual amount that you should have got from age 65. You can defer receiving the benefits as well. So you can defer it till age 70 and start at age 66 or age 67 or age 70, and you will get an 8.4% interest for every year that you defer receiving that money. So let's say if you defer and you want to start getting that money, that $1,000 a month from age 66, you will get an $84 extra. You will get $1,084 a month. All right. So that's how it works. And you can only keep CPP until age 71. After that, you have to transfer it to an account called Lira. So this is really important. Just memorize this. If it comes into a question that, hey, after age 71, where can I, basically put in my money? You can put it in a Lira account. Next pension that we want to talk about is called Old Age Security, OAS. OAS is for every Canadian that was living in Canada. So if you're still living in Canada after age 65, obviously, for receiving this money, you have to be 65 or older, okay? You have to be a Canadian citizen or legal resident, and you have to have resided in Canada for at least 10 years after age 18. So let's say I'm 65 years old, I'm still living in Canada, right? And I've already lived 10 years or more in Canada. I am eligible to receive OAS. And if you want to get the maximum amount, it is going to be 40 years that you have to be living in Canada after age 18. But let's say when I retire and I'm at age 65 or 66, I decide to, go to another country, right? And I don't want to live in Canada anymore. In that case, you must be living at least for 20 years in Canada. So there's always going to be this question that there's two buddies, they both got retired. One of them lived in Canada for 15 years, the other one, they both actually lived in for 15 years in Canada. One stays in Canada, the other one goes back to their, homeland country, whatever it was. And because it was 15 years, the one that moved back to their home country, they won't get that OAS anymore because it was less than 20 years that they were living in Canada. All right. So this is really important. Also keep in mind that OAS pension is something like Robinhood. If your income from other sources are more, they will pay you less, and then they will give it to the low income people. So you cannot start your benefits sooner than age 65. So it's not like CPP that you can say, okay, I want to start it from age 64 or 63 or something like that. And second is that you are allowed to defer receiving OAS till age 70, okay, which will give you a 7.2% interest for every year. So just like how we calculated for if you receive the money sooner in CPP, which is a 7.2% penalty, for OAS, if you defer it, it's going to be a 7.2% interest. Now, you can also defer it for after age 70 as well. You're not going to get any interest, any 7.2% interest, but inflation will be added to it. So whatever the inflation rate is after age 70, and you're still not receiving your OAS, the government is going to add inflation to that benefit. All right. So that's important. It's not going to be just still, or it's not going to be growing by 7.2% after age 70. It is just going to grow based on inflation. And you cannot split it with your spouse. But something that's really important here, and we're going to talk about it in the next pension plan as well, is that let's say A and B are married together. A is 66 years old and B is 63. And A dies. Okay. B can get the OAS from A that A was receiving until age 65, which they start getting their own OAS because you can't get OAS sooner than age 65. So the survival spouse, okay, can receive the OAS pension of the deceased spouse if they are between the ages of 60 and 65. So if A was 66 years old, but B was 56 years old, right? B will not get the OAS from A if they die. But when they reach age 60, then they will be eligible to get the OAS of this person who died. Okay, so this is really important. If they are under age 60, the survival spouse, they will not get their OAS until they reach the age of 60. From 60 to 65, they're going to get the deceased spouse's OAS. And after age 65, they're going to get their own OAS pension. Okay, so this is another important part that will come into your exams. GIS, if your income is still low, and you can go into the Canada.ca website, it has a part that it says what is considered as GIS, OAS, and blah, 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 and low income earners. If after retirement and after receiving all the different pensions and incomes that you're getting, you are still considered to be low income, you will be eligible for guaranteed income supplement. GIS. So it's only available for low income individuals or couples. You must be living in Canada, so you can't just decide to go live back home or any other country. You must be residing in Canada after retirement. You must be receiving your OAS as well. You can't say I'm deferring my OAS and then I want to get GIS. You should be receiving your OAS in order to be getting your GIS as well. That is why that benefits start from age 65, just like OAS. And again, survival spouse must be between 60 and 64 to receive the benefits, right? And this is the only benefit that is tax-free. So CPP, it's a taxable income. OAS, it's a taxable income. But GIS, it's tax-free. So remember that. You will be paying tax on your CPP and OAS, but not on your GIS. This was the information about CPP, OAS, and GIS. It's really important. These notes, it will come into your exams, and also you have to be aware of them because this is how you can treat and help your clients as well. Let's talk about the saving plans. So we have a couple of different saving plans as well. I guess the most common one and the most famous one is the RSP, Registered Retirement Saving Plan. Okay. So an RSP is based on the contribution room is based on your gross income. So it's voluntarily, you're not mandated to do it. Like CPP, you're mandated to pay a portion of your income to CPP, but for RSP, it's not like that. Okay. Contribution is voluntarily, and also it is from your gross income. It's 18% on your income. What is RSP going to do? It's going to allow you not to pay tax on your income. So you're going to be investing, doing that investment from your gross income, whatever investment you choose. It could be a stock, a mutual fund, a bond, but you put it inside an RSP account. Okay. But whenever you want to take it out, it's going to be taxable income. So you have to pay tax on 100% of the money. Even if it's capital gain, even if it's interest type of investment, it doesn't matter. Let's say you've put in $20,000 in your RSP and now it turns out to be $100,000. You have to pay tax on the entire $100,000 based on your marginal tax rate that we talked about earlier. Okay, so this is how it works. So the contribution will be taxed upon withdrawal. That's why we call it tax deferred. You're not going to pay tax in the beginning on your income, but you will have to pay tax on it at the end. The maximum amount of contribution is 18% of your previous year income, right? And it is carry forwarded as well. So if you haven't used your contribution rooms in the previous years, you can use all of them at once if you want to. And most importantly, this might become, and this might come in the questions, then how much can you over contribute, right? So you contribute more than your limit. You can do that for once without penalty up to $2,000. So if they ask that, what is the maximum amount this person can contribute without any penalty? It is going to be whatever the contribution rules was from the previous years. You add all of that, you can add another $2,000 to it as well. And they can only do that once. Maximum age to contribute and have an account is 71. After age 71, you can transfer your RSP to an account called RRAF or a term 90 annuity. Okay, so after age 71, you can transfer your RSP to an RAF or to a term 90 annuity. Also, you can only use your RSP before, well, you can use your RSP anytime you want, right? You just have to pay the tax. It's not necessarily when you want to retire. Okay, so you can put it this year, you can withdraw from it the year after. What's important is that you can also take it out if you are a first-time home buyer, right? And basically how it works is this. It's going to be 0% tax. It's going to be 0% interest, all right? But you have 15 years to give it back. And it's up to $60,000 as of today in 2025, okay? These numbers might change, but let's say you want to buy a home. It's going to be your first home. You can take money out of your RSP account, whatever amount you have, right? Up to $60,000. You don't pay any tax on that withdrawal. You don't pay any interest on that withdrawal, but you have to pay it back in 15 years. That's what this last sentence means. Let's talk about the next one. It's called an RESP. This one is for education. Now, I want to tell you something about this. See, RSP, RESP, and the next one that we're going to learn about, RDSP as well. So these are all registered accounts. That's what this first R means. It means that it's a registered account. It's with the government. And whenever you want to invest in an, you want to invest through a registered account, you have to keep in mind that the contributor, the account owner, and also the person that is going to take the money out has to be the same person. So I can't be opening an RSP for my son, or let's say for my brother or for my sister. We do have something called a spousal RSP, right? That you can open for your spouse, right? And contribute in it. But overall, these accounts are always for individuals. Basically, they have to be the same person who is contributing, depositing money, withdrawing money, and all of that. But RESP is the only account that you can do it for your children. So the person who opens the plan is called the subscriber. The person who uses the plan is called beneficiary, which is usually the child. There is no tax advantage on this, right? You could have an individual RESP. That means for every child, you have a separate RESP. You could have a family RESP as well. So All children are involved in one account, and any of them that goes to school can use that RESP account. The contribution limit is $50,000. The government gives a maximum amount of grant of about $7,200, and the payments are only going to be given when the beneficiary or the child goes to school. So if they don't go to school, the government is going to take away the grant, and it's going to be subject to penalties and taxes and all of that. So it's going to be a really awkward situation. Make sure your children go to school. Okay, so this is what an RESP is. And also the beneficiary has to pay the tax. Okay, so when you take out the money, the beneficiary has to pay the tax on the growth. What is an RDSP? A registered disability saving plan. Again, you can open this for your disabled child that you had, or maybe a dependent, or maybe even for yourself. But you have to be eligible for disability tax credit. You have to be a Canadian citizen or legal resident. You have to be under 60 years old for opening this account. You have to have a valid SIN number, which is really important. Contributions are not tax deductible, and the contribution limit is $200,000. There is no annual contribution limit. In RESP, you can't put this whole $50,000 at once, okay? But in an RDSP, you can put this $200,000 all at once. And then the government usually pays up to 300% of your deposit, maximum $70,000 as a grant. When they're taking out the money, again, it's going to be taxable income, okay? So that is what an RDSP is. So RSP, RESP, and RDSP, these are the most important notes that you have to know just to save time in the exam that you don't need to be searching about these, right? It's going to help you a lot. Let's talk about income funds. So income funds, or let's say, well, not really income funds, other types of accounts as well. One of them is called TFSA. All right, so tax-free saving account. It is an account where you can open it if you have a valid SIN and you're over 18 years old. Okay. Each year the government gives that additional contribution room, so it's different from RSP. RSP, it was based on how much you made the year before, right? But TFSA is not based on your job or your income. It's basically whatever the government announces. If you want to go back, again, OAS has nothing to do with you working. So OAS, GIS, it doesn't matter if you worked or not, but RSP, it does matter. CPP, it does matter. TFSA, it doesn't matter as well. Okay. Um, you cannot deposit more than a contribution room. So unlike RSP that you had a $2,000 maximum with no penalty, you don't have this in your TFSA. Any gain is going to be tax-free. So whatever you put in, again, you invest from your net income, unlike the RSP. So it's after tax income. You invest anywhere you want. You put it in a TFSA account, and then whatever takes out comes out is going to be tax-free growth. So let's say if I put in $10,000, that $10,000 turns out to be $100,000. I've already paid tax on this $10,000 because it's coming from my net income. So I pay tax on my income, but I haven't paid tax on the $90,000 growth that I've made in this investment. Okay, so this $90,000 is going to be tax-free. So I'm going to take out the entire $100,000. There's not going to be any tax on my growth. Okay, so that's the most important part. If you withdraw money, this is really important. It's going to come into your exams as well. If you withdraw money, let's say your contribution room is $50,000. You've already put in $25,000. Okay, so you have $25,000 of free contribution room. You've put in $25,000 as well. Now you withdraw $5,000. How much can you put back in? You can only still put in $25,000. Okay, you cannot put in $30,000, even though that right now there's only $20,000 in your TFSA, right? And your entire contribution room is $50,000, but you have to wait until January to be able to use this portion that you've already reduced and deducted. Okay, so this is really important. It comes into exams as well. $50,000 is the entire contribution room. Let's say you've put in $25,000, so you have $25,000 of room, and you have $25,000 money inside it. Now you take out $5,000 out of that $25,000. You have $20,000 in your account, right? But you cannot put in $30,000 right now. You can only still put in $25,000. You have to wait until January to be able to use this $5,000 of contribution room plus whatever the government is going to announce for the next year. So let's say if the government announces another $6,000, that means that you can put in $36,000 in January. You had a $25,000 contribution room carry forwarded. You took out $5,000 that in January you can put it back in. And also the government added another $6,000 for the next year. So now you have $36,000 of room. I hope that made sense. Okay. Next one is RRIF. I really don't know what this is. It's a registered account as well. But it's really important to know that it's funded by transferring the RSP funds. So as I mentioned when I was talking about RSP, that you switch things, right? Um, and what happens is that after age 71, you have to transfer your RSP, and you can transfer it to an RRIF. Their investment options are the same as RSP, which is really important. RIF has a mandatory minimum withdrawal. That's what's really important. So every year you have to take out some money out of it. There is a chart and there's a table in basically in the book when you search RIF that it gives you exactly based on your age what percentage at least you have to take out. So that's really important. LIF, Life Income Fund, is suitable for transferring DCPP to retirement income. I'm just telling you guys so you can memorize this. Money can stay until age 90. All right. So, you can have that money until age 90. And the reason why is that this one has a mandatory minimum and maximum withdrawal. So if they ask in the exam, what is the difference between RAF and LIF? The difference is that RAF only has a mandatory minimum withdrawal, but LIF has a mandatory minimum and maximum withdrawal. So you can't take all the money at once. Eventually, by age 90, you have taken all of it out. Okay. It's the same thing with RAF as well. But that minimum withdrawal that you are mandated to take, it's going to finish by age 90. So that's the difference between these two. What they are, I really don't know. It's part of that 20-30% that I'm not going to be talking about. So we reviewed a lot of great and important accounts as well. And their bullet points. So TFSA, RSV obviously is the most important ones, and OAS as well. Let's go to the last part of segregated funds. It's honestly amazing how we can talk about all of this in about an hour or an hour-ish, while people might take days or weeks to study for segregated funds and annuities. Honestly, after reading this and listening to this, watching this video, you just need to maybe, do a couple of mock tests, so you can align and calibrate whatever you've learned to how it's going to be looking like in the exams, and just go based on your logic, and you're going to pass. Easy as that. So annuities are exactly the opposite of life insurance. In life insurance, you pay premiums, right? You pay periodic payments, and then eventually, when you die, your family or your beneficiary is going to get a huge amount of money. In annuity, you pay a huge lump sum amount of money at the beginning, and then you get periodic payments. Okay, so this is exactly the opposite of annuity. These payments that we're getting can be in different ways. It could be level. That means that let's say it's going to be $5,000 a month. So it's always $5,000 a month. It could be indexed. So it could be going up based on a percentage. Like let's say every year, let's say first year you're getting $5,000 a year, right? Next year instead of 5,000, it's like more, it's like a 5% increase every year, right? So you're going to get 5,250, right? And then the next year after that, you're going to get another 5% increase. It could be based on inflation as well, okay? Depending on the type of contract that you signed. It could also be variable income. So you put this money inside, some investments like funds and stuff like that. And based on how that fund is, performing, your payments are going to increase or decrease. Okay. So it could go up, it could go down. So we have three types of payments. It could be just something level, it could be indexed, or it could be variable. Now, let's talk about the length of these payments. Sometimes it's a guaranteed annuity. So let's say it's for 10 years. All right. So when it's for 10 years, what does that mean? That means that the insurance company is, promising to pay for 10 years. If the client passes away before the 10 years, the beneficiary will receive the money. Okay. They will be starting getting those payments. But when we have a life annuity, if the client passes away, even after the first payment, the entire money is gone. The payments stop, nothing goes to the beneficiary. So that's the difference between a term and a life annuity. A term annuity has a guarantee period, right? That if the client even passes away, their beneficiary is going to get the money. A life annuity, it's gone. There is a combination of term and life as well, which means that it's like a life annuity, but with a 10-year guarantee. So in the first 10 years, if the client dies, the beneficiary is going to get money until the end of the 10 year. After 10 years, if the client dies, the beneficiary is not going to get anything and it's over. Okay. So that's another type that we could have. It's a combination of both. Um, Something that's really important, when you deposit this money and you get your first payment, you can't cancel and say that I want my money back. It's gone. If you cancel, you don't get anything. We have a different type of annuities in terms of length, which is called impaired annuity, right? And these impaired annuities are basically life annuities, which that client has low expectancy life. Okay. So let's say if the client, it's usually less than 2 years. So if the client is expected to die in the next 2 years, they will give them a life annuity with a higher interest rate. So it gives them just more money because they assume that they're going to die in the next 2 years. I don't know who's going to do that if they're dying in 2 years and will decide to get a life annuity, an impaired annuity, but anyway, it might happen. So till now, what have we learned? That the payments can be level, they can be indexed, and they can be variable. The length could be guaranteed, a term. It could be a life annuity. It could be a combination of both, and it could be impaired annuity as well. And something else that's really important is that if this is a registered annuity, so it's with the government, or it's when we transfer our RSP to a term 90 annuity that we talked about, It doesn't matter who the beneficiary is. It might be the son, okay? It might be the daughter. But if the spouse is still alive, it's first going to go to the spouse. Same thing with RSP as well. Any registered account, if the person dies, the beneficiary is always the spouse, unless the spouse is dead. Then the beneficiaries that were assigned in the policy or in the contract will get the money. Okay. So if somebody has assigned their son, their daughter, whoever else, their brother, sister, as the beneficiary of this account, right, or this annuities or RSPs or whatever, if the spouse is alive, it will first go to the spouse, and after that, it's going to go to the beneficiaries that they assign. So the payments can be level indexed variable. The length can be life annuity, term, or impaired. And we have three different types of annuities as well. We have immediate annuity. Immediate annuity means that you will start getting your payments from the first year. So let's say if you open it 2025, your first payment, when we're talking about immediate, it means that you're going to start getting it from 2026. Okay, so immediate payment basically means that you're going to start getting your payments from next year. This is what we call an immediate annuity. If I decide to get my, basically annuity payments from 2 years or longer, right? So I don't want to get it next year. It's going to be called deferred annuity. So let's say I deposit this money right now. I give this money to the insurance company, and I say, okay, I want to start receiving the payments after 5 years or after 10 years. Okay, so since I'm not getting any payments until the next 5 years. If after 2 or 3 years I change my mind, I want to cancel the contract, I can do that. But if it's an immediate annuity and I've got my first payment, then if I cancel, the money is gone. They're not going to give it back to me, the remaining. Okay. So that's what we call a deferred annuity. The third type of annuity is a prescribed annuity. And a prescribed annuity means what? It means that you will decide to pay the taxes in the first year. So if I want to pay the taxes of gaining the, because I'm eventually going to make money out of this, right? I'm not that dumb that I'm basically going to be giving, let's say, a lot of money as a lump sum, and then just decide to get the same amount of money periodically. I'm definitely looking into having some growth. So let's say if I'm putting in $100,000, I'm expecting that in that term guarantee, let's say if we have, I'm expecting to get like $150,000, but periodically. Okay. So when I say, so there's a $50,000, let's say, of growth in the long term of this, contract, right? And I have to pay tax on that $50,000 gain. So what happens is that it has to be an immediate annuity because prescribed annuity means that I'm going to be paying all the taxes of this annuity in the first year. So I can only pay the taxes if I'm getting the money in the first year. So it has to be an immediate annuity. And it also has to be a level annuity because I have to know exactly how much I'm going to be getting in the next 10 years so I could pay the taxes. If it was going to be indexed or variable, then I don't know exactly how much I'm going to make by end of that term. So I could say, okay, I'm going to pay the taxes. But it doesn't necessarily mean that if it's a level annuity, it has to be an immediate annuity, or an immediate annuity has to necessarily be a prescribed annuity. So this is only a one-way relationship. If it's a prescribed annuity, it's definitely an immediate annuity, and it's definitely a level annuity. But it could be a term, it could be a life annuity as well. All right. So that's another important part. Okay, so we talked about annuity as well. We talked about, what they exactly mean. It's the opposite of life insurance. You get monthly payments or yearly payments, whatever it is. And we talked about the different types, the different lengths, and the different payments. So we cover segregated funds and annuities, I would say 80% of it. And that is basically what's important. If you guys have any questions, please reach out to me on the comment section. And I wish you guys all good luck in your exams. Thank you.